we're always looking backwards in the housing market. So we're reporting today on this, oh, everything is great, when really it's not. The last 2 weeks have fallen apart. A lot of the data is being hidden. Affordability, I would say, post-World War II is probably at its lowest since then. The jobs market is really the only thing that hasn't fallen apart.
I absolutely agree that some of that is kind of going on with the data. The stress and the crack in the market is this affordability. I mean, last year saw the fewest existing home sales since 1995. And if you look at the last print we just got, it's actually the same print that we got in 1978. And we had 130 million fewer people in the country. And so the existing side of the market is very constrained. It's constrained not just because so many buyers are priced out of the market, but it's also constrained because a lot of people who would like to sell, they can't afford to.
Housing market data journalist and real estate editor Lance Lambert has been covering the U.S. housing market in detail for many years. Lance worked for Realtor.com and Fortune.com, and he says the U.S. housing market fundamentals are changing. Home inventory is rising across most of the country, and price reductions are plaguing home sellers wanting to break the bank on record home sale profits. This may only be the beginning for a historical, massive housing market correction. Cracks are showing up all over as the hottest U.S. housing market post-World War II finally cools off. Now let's listen as Lance methodically breaks down what everyone interested in the housing market should be hearing. Real estate is the largest market globally, contributing to a major part of GDP, and any major downturn in this housing market will have a rippling effect for years to come. I hope you enjoy the show. Lance, thank you so much for joining our show.
Yeah, thank you for having me. I really appreciate it.
You know, I find it interesting, as we had spoken a little bit off camera here. I have been following your work for quite some time. Of course, you know, I've been in the housing market for a long time, but since I've been podcasting, I've quoted you, your articles, and you know, I'm really kind of excited to dive in here today. But first, I have to ask, you know, how in the world did you start reporting on real estate?
Yeah, so I had went to school and studied economics and journalism, always wanted to be a financial journalist. And I'd worked at several publications, did a little bit of the time at daily newspapers, and I was at Bloomberg for a while. And when I was at Bloomberg, I decided, you know what, I'm going to pivot my career, go more towards become a data scientist. So I decided to leave journalism. I was kind of tired of it. Didn't feel like it was the right thing for me. And I went to work for Realtor.com in 2017. And while I was there, I dug into their data every single day. And it wasn't just 8 hours a day doing my job. It was also because I was trying to become a data scientist. So I was digging in so deep into their data. They had data on almost every house across the country and all this partnership data and proprietary data. And I was doing my own analysis with it. And at some point I decided, you know what, I'm going to stay in journalism. I'm going to stay in media. But I'm going to pivot and become more of a data storyteller. That's what interests me more. And so I left Realtor.com to go work at Fortune Magazine. And when I was at Fortune Magazine, I was doing a newsletter, data newsletter for Fortune 1000 executives and CEOs. And it was very much just like trying to find out what's going on in the economy, what are the big business trends, and then running polls on these Fortune 500 CEOs. And while I was there, and I had started in August 2019, spring 2020 comes, the lockdowns occur, all that craziness. I was one of those people that my wife and I were living in Manhattan. We had a 3-year-old and we're like, you know what? We need out of here. We want more space. Had a house built back where we're from, Cincinnati. And during that time, to see what was going on in housing, and things started to, you know, we went from a few week period where people were like, oh, this could be bad, right? For housing, and builders were kind of scared, to within a few weeks, things were taking off. They were ripping in a way that we had not seen in quite some time, since the early 2000s. And so just that shift into a boom mode, and people were so concerned, like, what does this mean? What is going on? And so they wanted answers. And a lot of the traditional articles written by a lot of media publications weren't getting deeper into the data, especially on a regional level. And so I just started writing about housing just because I was interested in it. It wasn't my beat there. Fortune never asked me to do anything on housing. I just started doing it. And then while I was there, I started to build a media business for them called Fortune Education, totally in a space that I wasn't interested in. But what happened is I got that itch of entrepreneurship, having built something for them like that. And I just, I kind of love to grind and build things and, and push hard in a direction. And so once I got bit by that entrepreneur bug, and then I had also had, success writing about housing and doing data in the housing space, and people were really into my work. And I think readers could tell that I was curious and trying to find out what was going on. And so at some point at Fortune, it was just kind of a natural decision to be like, you know what, the next point in my life, I'm just going to build a business in this space. And that's what I did with Resi Club. And we are a niche media and research outlet that just focuses on the US housing market. We're not trying to cheerlead for any one group in the audience or in the sector. We write for everybody from homeowners, buyers, sellers, renters, and then really all the industry folks, home builders, loan officers, real estate agents, people who deploy institutional capital into the space, you name it. If they want to know what's going on in the housing sector, we're trying to get the data and trying to make sense of it. And then we have a huge regional focus. We do the data on 800 metros, 3,000 counties, and then every zip code in the country.
We have a lot to talk about, a lot to cover, and you certainly got into the housing market and probably the most exciting time to report on it. I want to just kind of take a step back and talk about your Realtor.com experience, because, it's amazing the data collection of a company like Realtor.com. I was in New York City, lucky enough back in the day to be invited to a broker meeting that Zillow had a couple years ago, but I think it was back in like 2017, really before things were getting crazy, well before the pandemic. And it was amazing how much data and information they collect on people. And, I know that's becoming more and more difficult. But when, with Realtor.com, was there, and you kind of started about that same time that I went to Zillow, was there any talk amongst the executives there on what we experienced with the housing market? I mean, were there predictions back then with interest rates being, super low, really since the GFC? Mortgage interest rates have been doing a deep dive, a downward spiral to all-time lows. Was there ever any kind of conversation that sort of indicated where we were headed?
Yeah. So back then, and of course, nobody back then is going to guess that there's going to be, a pandemic, lockdowns, mortgage rates go to 2%, a huge increase in housing demand, and all of that. But what there was discussion of was a general consensus that between the end of the decade, 2019, into the early part of the 2020s, that would probably be a strong period for the housing market. And the reason being is if you look back at the demographics and births, the 5 largest birth years for millennials are 1989 to 1993. And so if you add 30 years onto that number, which is generally now when people, back when it used to be 25, but now it's closer to 30 first-time home buying. If you add 30 years onto 1989, that takes you to 2019. And so all of the biggest chunk of the millennials going into their 30s was occurring between 2019 and 2023. So back then there was a general view that there would be an elevation in housing demand. Now, when the pandemic occurred, a lot of people in the industry were like, "Oh, look, that's that demand." But really, if you unpack it, the pandemic housing boom was driven by a lot more than just demographic demand, in my view at least. And the Federal Reserve put out a paper in the second half of 2022 that they found that housing supply would have needed to have to increase 300% to match the elevation in housing demand during the pandemic. Housing demand during the pandemic soared. Unlike supply, which isn't really elastic, right? Like I mean, there's some of the housing stock in the country, at least in your state, Maryland, and mine in Ohio, some of it dates back to 30s, 40s, 50s, right? So housing supply as a stock takes a long time to change, but demand can be elastic and can fluctuate. And what occurred right at the get-go of the pandemic housing boom is that big elevation in demand. And that was driven from a few different parts. Yeah, maybe the demographics is a piece of it, right? Because it's a favorable demographic window. But a big part is mortgage rates went super low because the Federal Reserve uses housing to cyclically boost the economy. And then when they need to tighten, they pull back at it, right? So during COVID, they went to super low rates. They were buying up mortgage-backed securities unlike any other time in history. The average 30-year fixed mortgage rate fell to a 100-year low from 2020 into 2021. And then we also had the secular shift where a lot of people were sent home during the lockdowns and they could work remotely. And a lot of people were like, you know what? I would like to leave San Francisco, Los Angeles, Seattle, Portland, New York, DC, and go somewhere further out. And so that elevation in housing demand created a very big uplift for a lot of secondary and third markets. And then also for anywhere deep in the exurbs, right? Which was great for home builders because a lot of the places people were seeking out had a lot of new construction. And then there was also, even in the markets that were losing people, like San Francisco, the prices there and demand still went up. And how is that possible? Well, there was a decoupling and a decoupling of roommates and an increase in household formation. So a lot of people who were working from home during the pandemic were like, you know what? I'm sick of seeing my friend John every day. And we're cooped up in this small apartment working at the same time. And so there was a big decoupling there. And then the other thing that can't be ignored about that window is the fact that there's so much stimulus money and, stocks and other assets were ripping. And so that wealth effect helped to accelerate the household formation and this housing demand. And so that's kind of my view of the pandemic housing boom, which is you kind of already went into that window with months of supply being fairly low, not a ton of active inventory from a historical lens. You had the demographical lift, but then you also had ultra low rates, an increase in overall housing demand from people seeking more space and work from home, and then also the stimulus. And it was a perfect storm. We've never had home prices in a 2-year window go up as much as they did during the pandemic housing boom. As of March 2020 to April 2024, home prices are up 47%, with most of that coming in the first 2 years of the decade. And if you zoom out just 3 more months back to December 2019, so the whole decade so far, we're up 51%. So we have already done more home price appreciation for the 2020s than we did all of the 1990s. That was 33%. All of the 2010s, and we are kind of around close to where we ended in the 2000s, although that's after the 2000s went up 80 something percent, busted, and then finished the decade up 50 something.
I still have a couple of questions on the realtor.com on that side of things with the discussions that maybe you guys had or didn't have. But with your analogy, and I mean, we've lived it, I completely agree. And since what you're calling the pandemic boom, we've become very unaffordable on both the purchase side and the rental side. I mean, people are struggling financially to make payments. I mean, I'm talking to people that make decent money where you have, in one couple in specific that bought 2 years ago, together they make over $200,000 a year, and they bought a pretty modest home. And, they didn't spend a whole lot of money, but repair costs, insurance costs have gone up, and their taxes have gone up. This property taxes, despite having a homestead tax credit, still have raised to a point to where they're basically just living for their house. Completely agree with everything that you said. As the causation of this was the perfect, like you said, the perfect storm. Lance, where are the cracks? Where are the cracks in what you just described, where you're doing the research? Do you see a contraction happening? And I'm not trying to put a magnitude on, a crash greater than the 2008 crisis or whatever, but where are you seeing the contraction cracks, and what do you think will ultimately happen over the next couple of years?
Yeah, so we went through the fastest ever deterioration in housing affordability. Now, we've had housing affordability technically be a little worse in like 1981 when we got to 18% mortgage rates, but the speed of this deterioration is super unique. I mean, people, when you do the math of going from 2-3% mortgage rates to 7-8%, that's far worse than going from 10 to 18%. If you actually get it out and figure out the monthly payment change. And so not only did we have an overheating on prices, not only did we have a historic mortgage rate shock, the fastest in several decades, and arguably the fastest ever. And then not only that, but we have this home insurance shock that's going on. Between 2018 and 2021, there was only one time that a state saw more than a 10% increase in 1 year for their average home insurance premiums. So one time in 4 years did a state see it. Last year, 25 states saw a 10% increase or higher for home insurance. And that's not even over. It's not even worked its way through. And what's happening in the home insurance market isn't all just because of climate risk. And now there is a part of it that is catastrophic losses from Hurricane Ian, which is the third costliest hurricane in U.S. history that hit in September 2022, caused a lot of pandemonium in the insurance market in Florida. But it's also this housing inflation, and the cost of repairs have went up so much, the cost of replacement, that all trickles over into the insurance shock. So you don't just see prices go up, it trickles into other areas when you have this affordability deterioration and inflationary shock. Now, the fourth leg to this is the hardest one and the one that varies the most across the country and will take the longest to play out, and that's the property taxes increases, because a lot of homeowners in different states are kind of buffered from it. It takes a long time to work through it. And a part of how it is going to work through in some of these states is that it's going to be pressure from the schools and the local municipalities that need that revenue, that have kind of been cut off and haven't seen revenue increase as much as the other cost in the economy and housing in particular. And so the stress and the crack in the market is this affordability. I mean, last year, 2023, saw the fewest existing home sales since 1995. And if you look at the last print we just got, it's actually the same print that we got in 1978. And we had 130 million fewer people in the country. And so the existing side of the market is very constrained. It's constrained not just because so many buyers are priced out of the market, but it's also constrained because a lot of people who would like to sell, they can't afford to. I think I read the number, it's close to around 55% of homeowners, or maybe it's higher than that, could not afford to buy their current house at today's rates and today's prices. They just don't have the income to do it. And so if they were to trade in that 2, 3, 4% mortgage rate for 7, 8, not only would they not want to stomach the monthly payment, many of them wouldn't even qualify to do so. And so the crack right now is in affordability. Now, if you go across the country, some of the markets that went up a lot more than others are seeing more of a buildup in active inventory. And so active inventory is not just what's coming up for sale, it's everything on the market as of right now, right? And that's why months of supply is a great measurement for housing, because it's everything that's on the market today at the current sales pace, how long it would take to run through the system. And it's not to a huge number, but it is increasing. But in some of these markets like Austin, Texas, some parts around the Gulf, that not only did these places see more home price overheating during the pandemic because so much demand rushed into the market, they also saw more of the home insurance shocks, or maybe more of the property tax shocks. And so those markets are softening more, as some buyers just, the local fundamentals are more strained. And that in those places, as actives build up enough, some of them will see declines in prices, like we're seeing in Austin, Texas right now, like we are seeing in New Orleans, like we're seeing in Cape Coral, like we are seeing right now in Punta Gorda. The question marks right now are kind of the markets that are not quite to that level, but are kind of working there. So Orlando, Nashville, Jacksonville, Tampa, Dallas, those are kind of the question markets for me, because their fundamentals are strained. They have a good amount of new construction, and active inventory is building. They haven't yet seen much price give up, but if it continues, I think those would be the ones that soften more. The markets that aren't cracking as much yet, despite everything we just went through with this affordability, which is kind of shocking that they're not cracking yet, are a lot of pockets of the Northeast. I would say from Maine all the way to Virginia is kind of this resilient pocket. And then if you go from there and you head west, it's almost to Wisconsin. So this big jump, huge swath of the Midwest, Northeast, and the very top of the Southeast South has been fairly resilient so far. A part of that is because some of those areas, while they all overheated, some of them didn't get as strained from fundamentals as some of the markets in the Sun Belt. And then another very key factor here is that a lot of the places in those boom towns in the Sun Belt, especially around the Gulf and the Southwest, they have a tremendous amount of new construction, right? And so builders are very savvy. They're going to move product, right? And if they have to do a price cut, or they'll do it through an affordability adjustment, like mortgage rate buydowns, with so many of the publicly traded builders having their own in-house mortgage companies, they'll do it. So in the South and the Sun Belt, those markets have done more of that. And that creates a softening for the resale market, where if you're a buyer and, let's say, outside of Tampa or outside of Jacksonville, and you can go to a builder who's going to give you a fixed 30-year mortgage rate potentially, or some, that's some of the better incentives they do offer. And let's say it's 4.5%, 5%, or you could go to the resale market where that existing homeowner isn't coming to terms with the fact the market has shifted. They don't want to come off their price. And so a lot of the buyers are turning to new construction. And as more of that happens, the active inventory builds in the resale market. Whereas if you go up in the Northeast and the Midwest, because they don't have as much new construction, that cooling process and softening is taking longer. And as those markets still stay in very low active listings, very low months of supply, that's seen that prices still get pushed up in places like New Jersey, Connecticut, Wisconsin, parts of Michigan, despite all of this affordability deterioration. So if you want me to make a long-term prediction of where we're going, I'm going to try to avoid doing so, because I want to cover this more as a journalist. I want to be very careful to not say, okay, this is for sure where we're going to go, because I think there's a great deal of uncertainty. But the metric that I would suggest people watch is active inventory in your market. And so how could you get that? You could get it from realtor.com. You could get it from Zillow. You could get it from a local real estate agent. Redfin has some of this data. But you take the current month for your market. So let's say May 2024 or June 2024, or if you get it in July 2024. Take that number, everything active for sale in your market, and then go get what the number was in 2019. Divide it by it and then minus by 1. So that's percentage change. Or you could just Google how to do the percentage change. But if your market is super far below where you were in 2019, there's a good chance that your market's still tight. If your market is shooting up fairly quickly, you're probably softening. But if your market is already above or well above where you were in 2019, because back in 2019, there was much better affordability than now. So if you get above 2019 inventory now with this much more strained affordability, that's a telltale sign. There's probably greater than softness. It's probably more into weakening and more into price give up. And the price give up might have already started many months ago in your market.
Lance, that's a brilliant explanation and analysis of the housing market. I probably one of the best that I've heard anyone explain. I hope you're enjoying Lance so far, and I'd like to just take a minute to let you know that this podcast is brought to you by none other than our own SachsRealty.com. If you're in the market to buy or sell and you're in Maryland, we hope that we're your number one choice. I'd love to hear from you. And if you're anywhere else in the country, please visit SachsRealty.com, where you can click on the map of the United States, pick your state and city to find a real estate agent that we trust. This program is new to us here at Sachs Realty, and if there isn't an agent yet in your city, simply reach out to me, send me an email. I'll be glad to connect you with someone close to you. Now let's get back to our show. I love how you tied this to the shift in fundamentals, and that is the key, your explanation on the fundamentals, and that is explaining what's happening in the different markets throughout the country. I want to talk more on that, but first I want to get back to Realtor.com because I'm curious as to with all their forecasting. We're talking about a major corporation with all the data. They're aggregating everything, coming through the MLS, all the realtor activity down to the neighborhood level subdivisions. What type of conversations were existing as far as, if at all, investors in the marketplace? Because in 2017, we really didn't see one of the elements that heated this market up with a third of the home sales, single family home sales throughout the entire nation. I mean, it goes even higher. There were parts of Texas where, over 50% of the housing sales, single family housing sales, were corporate buyers or investors buying the housing, competing with homeowners. Was there any prediction back in the 2017 days where they were sitting around saying, we're going to see a, big influx of iBuyers and corporations buying up the single family inventory?
Yeah, so back in 2017, 18, 19, when I was there, even before the pandemic housing boom, you're right. There was more of a move into the housing market from the investor side. And some of that dates back all the way to 2011, 2012, when at that time it was it wasn't a mature sector, but the institutional capital was starting to move into the housing market, right? They realized there was this huge trade in housing because home prices had crashed, and they thought they were going to begin to recover. They were so far below replacement value that we saw that first real big move into the market from the institutional side. And what occurred is it happened for a couple of years. They were going around Atlanta, Las Vegas, Phoenix in particular, some of the markets that got hit harder by the crash, buying up a lot of these single family homes for rentals, especially in the lower price points. But then what happened is that trade was made, and they kind of pulled back for a bit. There wasn't a huge move in, but then that industry began to mature more. So I was talking to Gary Beasley, and I'm not sure if I'm pronouncing his last name right. And I butcher people's names all the time. I'm terrible with names. But he's the CEO of Roofstock. And back then, he was one of the first institutional players that moved into the market. And his company ended up getting absorbed eventually by Invitation Homes. And he had said in 2015, if you wanted to sell a portfolio of these institutional homes, you couldn't do it without first evicting everybody, because they just didn't have a process for selling portfolios of single family homes back then from institution to institution. So in 2015, he builds Roofstock, which in the pandemic housing boom, by the time that took off, then Roofstock And, these other companies that had kind of been built up in that space were ready for the sector to really get ramped up. And so at the start of the pandemic, they were doing about 10 million a month in home sales, helping institutions or other small mom and pops buy portfolios of homes. Within 6 months, they were up to 250 million a month in homes that they were buying for these groups. It ramped up that quickly. And so even before that began to happen, though, you're right, at 2017, 2018, 2019, we're starting to get the iBuyers move in. You get Zillow, create Zillow offers, I believe in 2018. And then by 2019, they were out to the races doing it in like 30 markets. And then the pandemic occurs, rates go even lower, historic lows. The Fed essentially creates a liquidity bubble that then pours into the institutional capital markets. The institutional side gets all this money. They have to deploy it or they have to give it back. And they don't get their fees if they don't deploy it. And so that money then gets pushed into the housing market. And so from the institutional side, while they weren't buying up an insane number nationally, it tripled to about 2.2% or 2.4% in Q2 2022 were bought by the institutional players that have at least 1,000 homes in their portfolio. And if you start to add in the ones who have 500 homes or 300 homes, you get it up closer to like 5% for the quarter that were institution. But in some of these markets, let's say Dallas, let's say Houston, Charlotte, Tampa, Phoenix, and Atlanta, those 6 markets were home to 36% of all the institutional owned homes in the country. And so in some markets, they were significantly bigger players. I mean, there's parts of Tampa that you could go to that are inland a bit, that you'll look at the numbers now and there's about 10%. There are a lot of these zip codes that are institutionally owned homes. And now in parts under Atlanta, same is true. And so you had a big influx from the institutional side, but it really was much bigger than the institutional side. They're still a smaller piece of the market. Now they are, although they're maturing. It was really everybody, the mid-sized, the small mom and pops. You had a frenzy of amateurs jumping into the market that were seeing things on like Bigger Pockets of like how to do short-term rentals, all of that. And so you go across the sector, institutional for SFR, build to rent institutional capital, Airbnbs, mom and pops doing it, everybody, because the rates were so low, home prices were ripping so much. There was the FOMO, people wanted to dive into the market is what occurred at the time. And in the Airbnb market, you also had the fact that travel was shut down, right? In terms of cruises, international travel, people didn't want to go into a big hotel during the pandemic and be packed in, right? Like a can of sardines. And so a lot of demand moved once the stimulus money started to roll through the economy. A lot of people started doing short-term rentals and they weren't in the office and more people were working remotely, used those 2 years to travel around the country. So what you see is a huge influx in demand for short-term rentals. You see home prices rip, you see rates go so low. So what that does is it pulls a lot of investors into the short-term rental market during the pandemic, but it takes time for that supply to hit the market. And so starting later in 2022, all of last year and this year, what you've seen is a correction in the short-term rental market where a lot of that supply is now moving into the market. The demand is no longer increasing like it was because cruises are back, international travel is back. A lot of these hotels have lower daily nights than these Airbnbs, especially when you add in the cleaning fees. And so we've entered into a correction. I looked at the numbers the other day from AirDNA. We're at like 15 straight months or 16 straight months of month over or year over year declines for short-term rental revenue. So Airbnb is making more money because there's more hosts, but because there is so much more supply, the individual hosts are making less money. And so in that market, you will probably, and you're already seeing some of it, some of that supply come back into the housing supply, into the housing resales supply. The institutional market, you're no longer seeing the huge bull rush into the market. Scatter buying just doesn't make sense right now. These cap rates and the returns at these interest rates and the repair cost and the fact that rents haven't kept up with home prices, there's not as much interest for scatter buying. And so we went from institutional players making up 2.2% of transactions in Q2 2022 to now it's 0.4%. So it's declined. That's a massive decline, over a 70-80% decline, and scatter buying is a percentage. You are still seeing some of the capital move into build to rent. There's still an interest in that market, so it's probably not going to pull back as hard as some of these other areas. And then it's going to be a question of, depending on where the economy goes, how things play out, how many of these new amateur landlords stay in, right? Because, once you get into it, you start to realize, wow, maintenance is a pain in the butt. I didn't budget as much for this. Oh, a renter just lost a job. Now I had to go find another tenant. Oh, I had to evict them. I have a squatter. So they start to run into those things. So anytime you have a huge run up and the number of amateur landlords coming into the market, there's always the possibility that some of them will get squeezed out over time.
Yeah, everything you're saying throws up caution flags to me. I mean, and what we've been saying, and I've been in the housing market for a long time. I mean, I've been serving in one form or another the housing market since 1989. And exactly what you're saying are exactly the things that I've been seeing and saying and warning people about. And it's not saying, I'm not telling people not to buy a house, Lance. I mean, look, if people are set on buying a house, they find a property that checks the boxes and they can afford to be there, then you know what? It's a life decision. But I think that what you're talking about isn't really being said. And I get it. You just described through the years of corporate buying, and a lot of these companies are Wall Street, publicly traded companies that are buying up these single family houses that have been competing with home buyers. And there is a certain narrative to that, hey, we need to just continue to push this thing forward. We can't see price declines. We can't see market adjustments. Not that they can control it, but they're trying to keep it as quiet as they possibly can. And I'm talking about mainstream media primarily. So I want to talk about, because the housing market is about 35% of GDP or housing related services by the time you get into the nuts and bolts of your trips to Home Depot. What you're saying right now from a journalist are things that need to be talked about. You're going to be amazingly successful, if that's even a proper way to describe it. But you're on to something really great. And I think your company is going to do fantastic. Congratulations on the courage to start it. What kind of political pressure, some of these other corporations like Realtor.com, for instance, that has a narrative to continue to push, how much political pressure is on the journalists, the writers, to keep with a narrative?
So when it comes to that side of it, in terms of the pressure, I didn't quite feel as much of that through my career. More pressure is probably to make sure that you're getting maybe people viewing your articles and stuff like that. So the pressure is probably a little bit more there. But in terms of, like, if you're asking if there's biases, of course there's biases. When I was a writer, I had a lot of freedom, tremendous amount of freedom. Now, I didn't take that in a direction that was, pushing a bunch of narratives in a certain way that was my personal viewpoints. I kind of took it more in a direction of a lot of curiosity, right? But I think, because so many different journalists, some of them have that freedom, maybe others are pressured by editors. Maybe sometimes, they're less driven by curiosity and they're more driven by partisan views or what they want to try to put out there. So I didn't quite feel it as much. In terms of housing coverage, I don't know if it's as much that or as much, it's just hard to know exactly where we're going to go, right? A lot of the experts, a lot of the housing economists there's an uncertainty there. Good number of people thought that we probably have already seen more price give up potentially in the second half of 2022. We did. And then in 2023, a lot of these markets tightened up after that mortgage rate shock. And so seeing the fact that there's been some pricing resiliency in some markets just makes people cautious of going too bearish in that direction. So housing is just really tough. And it's in these really long cycles, and not many journalists really pay a ton of attention to it, although it's a huge part of the economy. It's a huge part of what's moving the economy. It's a huge part of the biggest expense in people's lives. It's a huge part in people's personal aspirations for their life and where they want to be. And it is where they physically spend the most time. So you would think it would get more coverage and better coverage. But it's not sports. It's not politics. It kind of falls further down the journalist and a lot of news organizations' priorities, which is why I created Resi Club, where all of our focus, it's in our name. Resi stands for residential, and then club just stands for people who are passionate about knowing about residential. And so all we do is cover the U.S. housing market. And that's where I think our niche is, and our opportunity is, because so many of these other places are focused on other things. And if they do write about housing, they parachute into it. They don't understand the history of the market, how slow things change in housing. Usually, although during COVID, it was a little bit of a acceleration in a very unhistorically normal way. So I'm just kind of cautious there, because I think there's probably a lot of nuance to it, and less of people, being bad actors. Although, maybe some of that's out there.
Does it concern you, Lance, that with your new venture, a lot of and I know you're a data analyst. You're digging deep. You're trying to get as much information as you can. Really, what you just described over the last 15 minutes or so was really you didn't need a whole lot of data to figure that out. Hey, it doesn't make sense. These fundamentals are changing. Once you start looking at a home that costs 8 or 9 times a median salary for a median home, those numbers don't work. When you start looking at, these, I used to do Airbnb, but, now I realize that it's so expensive. And, now I need to take more days because, the neighborhoods don't want short-term rentals, or, I need to commit to 4 days and I really only need a 2-day stay or a 3-day stay. And I'm looking at the cleaning expenses, and a hotel is cheaper. So it doesn't make sense, all of these houses that are in these short-term categories. So we start looking at, rents don't make sense. These Instagram landlords, TikTok landlords that are standing outside of their, shutting the door to their Lamborghini or their Bentley or whatever, because they just sold millions of dollars in courses on how to buy with no money down, and, how to refinance it and take all your liquidity. But don't worry, when you put $20,000 in to get it rent ready again, it's going to cause you to default on your mortgage. They don't talk about that. But when we add all of those things up, we know that it doesn't make sense. And then we know that the only thing that can offset that is if people make more money, right? If salaries go up, because if not, we've got a major disconnect on our hands. So how are you planning how do you get the data? You were at realtor.com, that this is a market that the largest market in the world, one of the largest, is real estate. Why is it, do you think that, and do you have any plans on trying to invent more of the data instead of just aggregating and utilizing other people's data? Why is it that we have to wait so long to get we're always looking backwards in the housing market? So we're reporting today on this, everything is great, when really it's not. The last 2 weeks have fallen apart. How do you intend to provide a more accurate reporting?
Yeah. So in my view, I think I do it through the active listing data and how the actives are moving, because the actives are really that supply demand equilibrium. And that's why I watch them religiously. And they usually lead the prices, because you're right, especially if you're paying attention to these repeat sales indices, which I love them because they help to take out some of the mix shift in terms of, like, if you have a bunch of smaller homes go sold, it could change prices a bit. You have a lot of bigger homes that get sold, or more expensive ones, that could change the medians. So I like these repeat sales ones, but the problem is you have to wait for them to get transacted. In the real world, somebody has to agree to it. They then go pending for a while. And then finally, when they're finally sold and the county's reported it, and then the data gets rolled in. So the repeat sales indices, I love the methodology. They're great for research purposes. But in terms of, like, if you want to know your market right now, I mean, boy, they're really far behind, because not only are they waiting for the final transaction, they're also a 3-month average. So they're way back, and they average themselves, which makes them then even be further back. So you could have some sales for right now. The latest Case-Shiller is for the April reading. A lot of those are from sales that closed the 3 months before that, March, February, January. But a lot of those went under contract in December, November, right? So your April data, which is your freshest now in June, is including some things from all the way back in November. And so there is a very big lag there. So I watch active inventory. And if active inventory is moving, if it's building up, and it's building up much faster than normal seasonality, that's a flag. That's a red flag. And if you're in a market where active inventory is in a free fall, and it's falling much faster than normal seasonality, that's a flag that things are heating up. So I watch active inventory, and I like to compare it to versus pre-pandemic levels. Months of supply is another great one that you could do. And if you wanted, you could watch price cuts and things like that in your market as well.
How do you deal with, being in the housing market from a builder, contractor, that aspect for years and years, 35 years of experience with doing that, serving the housing market. The new home market is a big indicator on things to come, because that gets hit first, right? We're talking about, you just described, how sellers of existing inventory, they don't have to move. So they're looking at it and they're saying, well, gee, if I sell my house, I'm going to spend a lot more money and I'm going to have a lot less of a house. And now I can actually move my kids into the house, and I can have an apartment in my own house, let the kids take over the house. So we're dealing with that. But a builder has to sell their inventory, because that's where they make their money. So no transactions, no sales, no money, everything falls apart. They start losing shareholders. They start selling their stocks, or you watch things quickly deteriorate and go down the tubes. Not only that, but people would rather have a new house than an existing house, most people, because they know they can buy a brand new house, they get a warranty, and they get 7 years approximately of living there without really needing to worry about anything breaking, or even painting a wall for that matter. How do you deal with, or what is your plan in dealing with the projections, as you just described, looking at existing inventory models when builders aren't reporting their actual inventory?
Yeah. So the great thing about active inventory data is, even if you don't have all the data in the new construction side, in the real world, if there's a lot of new construction supply and buyers are like, oh, I could go to this builder. He has a better price. He's come down. It's new. I'm not gonna have to worry about replacing things as much. Sometimes it even has lower insurance, because some of these states are getting hit harder on the older homes. And oh, by the way, they'll do a mortgage rate buy down for me, right? Some of these builders are ponying up 50, 60,000 to do the buy downs. And so if more people are going to the new construction, that will build up resale inventory and existing home inventory. So even if my data can't capture all of the new construction that's out there, and I capture some of it, it will still it's not fully invisible, because it will have an impact on the resale market, right? And so you will see active inventory on the resale build if there is a lot of supply on the new construction side, just because that new construction side will then entice the few buyers that can actually still afford to buy the homes in this environment. And you are seeing that in some of these markets that have more new construction. And the classic example has been Austin.
Back in September, I think it was September 5th of 2023, Lance, you authored an article. It was titled, "The Housing Market Inventory is So Scarce That Builders Will Be in the Driver's Seat for Years to Come." And that was according to KB Home's CEO.
Yes.
Do you still think that is the same today? I mean, would you say that the builders are still in the driver's seat, or are you sort of looking at new home construction and the we're seeing these lots finally become finished? You mentioned there's a lag with that too. They have to start their permit process or developing land sometimes a decade in advance before they can stick a shovel in the ground. So do you think that this CEO was right in his analysis that the new construction or new builders would be in the driver's seat?
Yeah. So just to be clear, that is his take. That was his take on the market.
Correct.
That's KB Home CEO. They're one of the top 10 biggest builders in the country. They're a Fortune 1000 company. And I just talked to him actually last week, so I can tackle this one head on, which is he still kind of has that view of things are going well for the builders. His metric to watch is months of supply. And when I talked to him a year ago, there was less months of supply. We've came up a bit, right? And so in Florida, it's more than doubled. Now it's only went from a month and a half to like 3 something, but it has doubled. And so he's paying attention to it. He says that as of right now, they're not doing bigger adjustments in these markets. There was still a couple markets when I talked to him last year that were still in correction mode, where their pricing had gotten so far ahead of the resale pricing that they needed to come back in a bit, and that was in Denver. But for them, he had said that so far it hasn't affected sales, and that they're still selling, but they are watching months of supply. And if months of supply goes up too quickly or gets too high, they'll stop raising prices and they'll go into focusing on just moving product and clearing backlog. And so that's one builder. If you do look at the publicly traded, you will still see that the net new orders is still fairly, it's doing well for the builders. But the builder stocks, which had a huge year last year, Pulte Group was up over 120%. D.R. Horton was up 70%. They were well above the S&P 500. This year, a few of them are down, and they're all underperforming the S&P 500. And a lot of that is because these Wall Street firms are just kind of wait and see with the builders, right? Let's see, right? If active inventory gets high enough, what happens to these bigger builders, right? Do they start, is there margin compression? Do they have to spend even more to do price cuts, even more on buy downs to move product? And if that's the case, those margins will compress more, which are still above pre-pandemic levels. But that's kind of the wait and see on the big builders. Now, that's the big builders. The smaller builders that don't have these mortgage arms, they're not spending as much on buy downs. Not all of them are doing as well as these big publicly traded builders, who the big publicly traded builders had huge balance sheets, a lot of cash on hand to help weather, through this. The smaller builders, not as much that. And so you are seeing the bigger builders take market share right now. If you go back to 2005, around 22% of new construction, single family new construction, was controlled and done by publicly traded home builders. That up into 2019 was 35%. As of last year, it climbed to 50% now is publicly traded builders. And Zonda estimates in the next 2 years, it'll go up to 60% done by the big publicly traded builders. I don't think there's necessarily, at least the builders aren't saying like panic, right? And their numbers, while they're showing they're still spending a lot on incentives, they're they're still moving product as of the most recent data reported. Now, the next few quarters, it could change, right? Because some of this data that we've gotten these past 2 quarters is still lagged from, the past 6 months, which the market has shifted more since May, I would say, in terms of slowing for the seasonal for this year. And the seasonal slowdown this year has been sharper than some of the other past years.
Yeah, I completely agree with that. As a real estate broker, I mean, we are doing transactions here. I mean, we're not just a YouTube channel like many of the YouTubers that cover the housing market. I mean, they're not out working it. We see it. We've seen a massive pullback here in Maryland, in one of the best job markets in the country. We have some of the best employers here. We have the government, for crying out loud. I mean, some of the best jobs nationwide are right here in Maryland. And we're seeing, a big slowdown, a big pullback, where we're now seeing houses being listed that aren't going under contract in a week.
Yeah.
And the sellers are instantly dropping their prices because they're like, man, will this
in your market, active inventory moving up?
It is. So we're about 3.5 months of supply right now. And, a lot of it's price point. We still have a very short, affordable housing inventory. I'm not talking about in areas where, people don't necessarily aren't looking to live. I'm talking about in desirable areas, no affordable housing, really. But we're starting to see agents play a lot of games where they're dropping the list price by $100,000. We just had a situation in our sales meeting today where one of our lender referral partners that comes to our sales meetings said that, a different brokerage, but that her buyer actually paid or put an offer in and got the contract $100,000 over ask price, but they dropped the price to $225, and it ended up going under contract at $325. You can't really consider that, even in with normal reporting, because that was just stupid on the behalf of the listing agent, in my opinion. You don't have to drop a house price by $100,000 to get a frenzy going. You just have to keep it right under where it should be. And if sellers do that, instead of shooting high, if they drop it a little bit below where it really should be, you will still see multiple offers. But the catastrophic mistake sellers are making in a lot of markets right now is they're pricing it to, 23 numbers or 22 numbers and expecting that, they're just going to get any price that they put on the house. And we're seeing buyers saying no more and more to these scenarios.
Prices soften from the tops of 22 and 23 in your market now?
100%. Yeah, 100%.
I still shows Maryland fairly resilient. So it's interesting. So it looks like lag.
Lance, so what happens here is it's obviously very difficult to, to price two houses side by side because they're not very fungible, right? I mean, when you're looking at every product is different. Now there's a range that appraisers use, but there's certainly, it's very difficult to see two houses side by side. If you just take it from the standpoint of new construction, you can get new construction deals, and we have very little new construction, by the way. We're not, like what you're seeing in Austin, Texas, or some of the Sunbelt states where there's a glut of new inventory. We're very limited on our new neighborhood inventory in our neighborhoods, but we are seeing a softening in the new construction where they're giving seller concessions that they wouldn't have given. You mentioned buy downs. Rate buy downs are very expensive. So a lot of the data is being hidden because a lot of these big builders have their own mortgage companies where they take these types of reductions or losses, and absorb them in the on the loan side or loan company side, mortgage side versus the new construction. But we're seeing these rate buy downs are very expensive. It can cost $40,000 or $50,000 to buy down somebody's fixed rate mortgage for a 30-year time frame. The other thing is we're seeing that, like you said, hey, we'll finish the basement for you or give you these upgrades, and we'll do a lot of these types of things, which makes it very difficult, again, to price apples to apples. But in the the seller side, there are a few exceptions where we are seeing a solid price appreciation, and that is in inventory that is really nice, really clean, move-in ready, immaculate condition. If the property has distress, we're seeing where sellers are needing to fix things where they didn't before. So again, this is how do you compare apples to apples?
Exactly. So
Yep.
some of the pricing cuts don't get shown in the data, especially if it's in buy downs. If somebody has to go out and spend 30 grand in repairs to still get the same price, is that a price cut? It kind of is. It
It
essentially
is.
right?
It is.
So those things don't get showed up. But when you have a market that's shifted like this, that stuff starts happening, right? And
Yeah.
so if you go through back of some of these past years of, some of these other downturns for housing, some of the national numbers didn't really show drops, but it's because some of it got absorbed into other areas, right? Like we're discussing here. And then not to mention, if the inventory has to be perfect and it's the great homes that are the ones selling, well, if they become a bigger concentration of what's sold, that helps to buffer the numbers coming down more. So I absolutely agree that some of that is kind of going on with the data.
Exactly. So let's kind of land this plane and talk about the jobs market, because one of the things that I've said, Lance, is because people are asking me, this has defied everything. If you look at the fact that home asset prices are at all-time highs, the housing affordability index is at all-time lows, at least post World War II. The question is, was affordability from a monthly, with a payment versus your income, at 18% in 1981 or whatever the mortgage rates were back then. You could still in 1981 buy a house for $50,000 and make $24,000 a year. So, clearly 2 times your income, regardless of interest rates, you could buy a house. Certainly within 3 times your income, you could afford a home. In fact, a lot of people bought homes with only one person working in the household. You didn't have HOA fees like you have now. You didn't have condo fees. Some communities you have both, even with single family, they're condos and HOAs or master associations. You didn't have nowhere near the replacement costs or the insurance prices. So affordability, I would say, post World War II is probably at its lowest since then, right? Until after the World War II, they reduced a lot of the red tape and encouraged developers and builders to build affordable housing. And I'm not talking about government subsidized housing. I'm talking about affordable homes, which builders are not incentivized to build because their costs are too high. But when we look at the affordability index and it being so bad right now, the only thing that's kept it intact has been our jobs market, right? I've said that. I mean, it defied everything. Prices shot up. Now mortgage rates shot up. We're still seeing, I have a chart here, and I don't know what you think about Altos Research, but I'm a premium member of Housing Wire. I enjoy their data, their content. It is, great information in my opinion. But it says that a couple things are happening. One, if we look at total home sales contracts pending, if you look at 2024, we're still at 2023 level. So when we're looking at inventory being lower than 23, week over week, month over month, year over year, we're still 3.2 more single family homes in contract than we were last year, right? So a lot of this is not just an inventory issue. So when we're just looking at inventory, we're still doing about the same in sales as far as volume. But the big thing is that we're seeing a percentage of properties with recent price reductions nationwide go up. So in July, This is in the last week, 37.5% of inventory have experienced price reductions nationwide. Some areas are obviously higher concentrated than others, and I'm talking about single family inventory. But when we look at all of this, data, the jobs market is really the only thing that hasn't fallen apart. And I know, people say they're not reporting it right. Inventory or unemployment is much higher, that they don't count people after a year. But still, I mean, you're seeing people buying houses. What do you think, all of your reporting and all your data gathering with AI coming and, salaries being the largest, expense item in an income statement for many companies, and coming after the COVID pandemic boom, do you think we're going to see a massive spike in unemployment?
Yeah, that is the hardest thing for me to answer. It's the thing that a lot of the smartest macroeconomists have really struggled with this cycle, right? A lot of them thought when rates got jacked up at the 4-decade fastest movement up in rates in 2022, that we would quickly see some type of downturn, right? That unemployment, if it didn't spike, it was at least going to move up more than this, is what a lot of them thought. But it's been more resilient so far, at least the numbers, right? And that, like you said, has been a support for the past 2 years in this period of very strained affordability for the housing market. So where does the labor market go? That's a tough question. And that one kind of goes above me. And I'm always worried about making too many predictions, because the more predictions I make, the more it's going to take away from my reporting. And it's going to seem like I'm trying to make my reporting to match my predictions. So that's always my fear. But I do think there's a few things that I could note, which is, so far, the residential construction employment hasn't fallen off super hard. And usually that falls hard before the overall labor market breaks. So what is holding up residential construction employment? Well, we had a period of ultra low rates. And so a great deal of multifamily construction was financed during the pandemic, right? And so we are now starting to see a lot of that multifamily supply come into the market. This year, 2024, will see the most multifamily completions since, I believe the number is 1974. Richard Nixon was president. That's how much multifamily supply is moving in. But if you look at what leads or what is expected after that, well, it's expected to slow down. And so there could start to be some more multifamily layoffs, and residential construction might start to roll over more. If you look right now, if you Google housing starts for multifamily 5 units or more, they're down 52% year over year. Now, single family is only down 2% year over year. Multi is down 52% year over year for multifamily starts. So we're going to go through a lot of these completions that were financed in 2020, 2021, first quarter 2022. They're now going into the market. And then afterwards, we will start to see the effects of the rate shock on the multifamily pipeline. So that, I could tell you, is going to cool residential construction potentially. The other factor of residential construction, of course, is still the single family side of the market. So it's a question of where do sales go the next 6-12 months there, and then where do permits go with it. But right now, I would say I would expect some type of cooling headed for the multifamily market once we get through this bigger pipeline. But in terms of the overall labor market, I don't even want to pretend that I know where that's going to go. I'm so focused on housing, but I couldn't tell you that one of the segments of housing is going to start to soften more. And we've already seen in the housing sector, of course, mortgage went through the layoffs for 2 years, right? We're seeing a lot of realtors still leave the market. A lot of that side that's been on the transaction side has already softened and weakened, but it's been the construction side that has stayed more resilient. But a part of that is because the ultra low rates and so much of it being finance during that period has helped to keep it going through this.
Well, Lance Lambert, you are a rising star, I believe, in this industry, and I'm looking forward to seeing you just, deep dive even more into providing great analytics and data in the housing market. And I thank you so much. How can we help you? I mean, with your new venture? By the way, who you said that you have a partner, so you co-founded this. Who's your partner?
My partner is Anthony Pompliano. He has helped to found a few other different media ventures. He's been more known probably in the crypto space, cryptocurrencies. That's kind of been more of his area of expertise. But with me, the fact that, he was somebody who has already started some of these smaller media companies, that was really interesting for me. And also he's just somebody great to work with. And so he's a business partner with me in this venture. And then we also have a data editor that I hired from Fortune Magazine who used to report to me there, Megan Malice. She's on the team helping to make the charts, helping to do surveys, helping us to do research. And so Resi Club, if you would like to get our free newsletter, you could Google ResiClubAnalytics.com. You go there, type in your email, you'll get about 4 free issues a week. We also have a premium subscription, Resi Club Pro, which is where you get 3 additional articles. These are a lot more of like my conversation with executives, a lot more of my analysis for like 800 metros, 3,000 counties for home prices and for active inventory shifts. And then I also send out my, periodic zip code analysis for prices and inventory to the pro members. And then also, if you're a company that wants to do research with us or you want to do a survey with us, you could reach out. My email is lance@resiclubanalytics.com, and we're happy to help if you have any research projects.
Yeah, well, we'll publish all of those links down below, and look forward to hearing more from you and having you back on our show in the future.
Appreciate it. Thank you.
Thanks so much for making it to the end. If you enjoyed the show, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. And one of the biggest compliments that you could do for me here at Sachs Realty is to share this video with your family and friends so we can continue to build the most amazing community when it comes to everything real estate. And I'd love to hear from you, so drop your comments or questions below. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.